The top business stories live from the Sky News City studio. BP shares fall as the energy giant's profits disappoint. Shop price inflation falls for the fifth month in a row to its lowest since August 2022. And record earnings at Ultimate Products. I'll be speaking with the managing director. Good morning, this is Business Live with me, Ian King, and remember we are online only this morning. We start with some breaking news today related to West Ham United Football Club. It comes courtesy of our City editor Mark Kleinman, who joins me now. Mark, what have you heard?
Well, Ian, what I understand this morning is that Vanessa Gold, the daughter of the late David Gold, is in talks to sell a stake of up to 10% in West Ham United, last year's Europa Conference League winners. West Ham, who currently sit ninth in the Premier League, were valued at about £650 million the last time a major stake in the club changed hands a couple of years ago. And my sources tell me, Ian, that figure is likely to be exceeded if any transaction is signed by Ms Gold in the coming months. Now, she has hired Rothschild, the investment bank, to court potential investors. Her family trust owns about 25% of West Ham, so the Gold family trust will remain a significant shareholder in West Ham after any deal. And as I understand it, a number of funds which specialise in sports investments, minority stakes, have been sounded out in the last few days. And of course, Ian, this will be a further test of international investors' appetite to own a slice of the world's richest domestic football league. We, of course, expect the sale of a 25% stake in Manchester United to Sir Jim Ratcliffe to be announced in the coming weeks. Liverpool recently sold a small minority stake to an American private equity investor. There's plenty of appetite out there, and this will be another test of that, this potential sale of a roughly 10% stake in West Ham in the coming months.
Thanks, Mark. Much appreciated. Our shares of BP have fallen by more than 4% this morning after the oil and gas major reported lower than expected profits for the 3 months to the end of September. Well, BP's underlying replacement cost profit, which is the industry's preferred measure for the quarter, came in at $3.3 billion. That was up from the $2.6 billion achieved in the 3 months to the end of June, but it fell short of the $4 billion that the market had been expecting. BP also said it had booked a $540 million impairment charge against its 3 wind farms off the coast of New York after failing to win permission from the US government to renegotiate power purchase agreements to reflect inflationary pressures. Results are, of course, the first to be reported since Bernard Looney stepped down as BP's chief executive on the 12th of September after he failed to disclose to the board his past personal relationships with colleagues. Well, last night, strong gains on Wall Street were followed by another mixed session overnight for stocks in the Asia-Pacific region. Hong Kong, in particular, fell sharply after some weak Chinese manufacturing data. Well, here in Europe, stocks are all trading to the upside right now. Talking points today include the German power giant Uniper, whose shares are up by some 7% in Frankfurt on better than expected results. Well, here in London, the FTSE 100 also in positive territory, led by financial and industrial stocks, but it's still on course to suffer its worst monthly fall since June. In terms of the gainers this morning, well, Rolls-Royce is the leading percentage gainer. That's after it received a push from one of the brokers, while the gaming group Entain is ahead by nearly 3% in pre-results buying. To the downside, while BP leading blue-chip fallers on its results. Outside the FTSE 100, Essential remains wanted after yesterday's big disposal news, while lower down the corporate food chain, the sustainable fuels technology developer Velasys is off by some 68%. That's on news that it's in need of fresh funding. On the foreign exchange markets, the big story is the Japanese yen. That has fallen to its lowest level against the US dollar for a year, and that was after the Bank of Japan's move away from its ultra-loose monetary policy proved less hawkish than expected. Sterling currently up by 1/10% or so against the US dollar, but lower against the euro. As for the oil price, well, it's rallied after yesterday's big sell-off, but it remains well below $90 a barrel, as you can see on the screen. Well, joining me this morning is Guy Ellison. He, of course, is from Investec Wealth. Guy, good to see you this morning. Let's start with BP. Obviously, pretty disappointing numbers.
It is, and for a little bit of a context, BP is the first of the oil majors in the UK to update. We get equivalent numbers for the third quarter from Shell tomorrow. Between them, those two are a big chunk of our domestic UK market, about 13% in total. Expectations were quite high for BP going to these numbers. The shares have performed pretty well year to date. They're up around 15%, and that's largely because the oil price has been higher for longer. Of course, held in that $80 to $90 range more recently by the increased tensions across the Middle East. So market expectations were quite upbeat for BP. But notwithstanding that higher oil price, you always have these idiosyncratic company-specific issues that can impact on profitability, and that's what we're potentially seeing here with BP. Not only did they get less gas and oil out of the ground than the market expected, but also further down the business, the refining margins, the trading profitability that they've made also undershot expectations. It was quite a big miss versus forecast. Just shows you how hard it is, particularly for these oil and gas companies, to accurately predict how they're going to behave from one quarter to the next.
Absolutely. I mean, as you say, quite a big miss compared with the forecast. Is there any read across here for Shell? Because a lot of the miss seems to have been on the trading side of it. And, of course, that is a crucial part of the business for Shell.
It is as well. And some of that will be down to market conditions. Some of it will be down to the individual skills and positions of the traders that have been taken within those businesses. So, I think the market will be prepared for some softness, some weakness in Shell's equivalent numbers tomorrow. But it may prove to be that it's a company-specific issue, that BP's positions and strategy there in their trading division haven't quite been as on point as Shell's might have been.
Yeah. Now, in terms of the CEO succession, we didn't get any comment out of the company this morning. Would you have expected that necessarily?
Not quite yet. I mean, the time that's elapsed between Mr. Looney leaving the business and now has been fairly short, so we'd expect the board to do a proper search for the next CEO, clearly a crucial role, and that will be both an internal, possibly an external source as well. So no, we wouldn't expect that to be announced just yet, but clearly it's something the market wants to get some certainty on. What does it mean for strategy going forwards? If it's an internal candidate, will it be a continuation of BP's strategy?
Obviously, we've had a couple of major pieces of M&A in the oil and gas sector in the United States over the last month or so. BP looks pretty exposed right now with that stock price.
Yeah, and never say never. I mean, it's a big business in the context of our UK market, but for one of its international US peers who are an order of magnitude bigger, you wouldn't say anything's off the table with regard to M&A. I don't think today's move quite puts them in that target zone. They are still up around 10% over the course of this year, but consolidation, which had gone quiet across the industry over the last couple of years, is clearly back in vogue, and all names, I suspect, will be having the slide rule run over them. Yeah,
you'd love to be a fly on the wall with the new CEO's interviews, wouldn't you? Absolutely. Now, what about China? I mentioned there we had some disappointing PMI data out there this morning.
Yes, and that's weighed on the Chinese equity markets overnight. It comes on the back of what actually was a surprisingly good set of Chinese third-quarter GDP numbers that we had around 2 weeks ago, coming in ahead of expectations. These purchasing manager indices, the PMIs, are for the month of October. They're released every month, and they're the most real-time gauge we have into the health of an underlying country's economy. In this case, for all the PMI readings, a number either side of 50 indicates expansion or contraction of the economy. The market expected both of these numbers to be slightly ahead of 50, indicating expansion. As it was, the manufacturing part of the PMIs for China, which is the bigger part of the Chinese economy, actually came in just below 50, so showing a slight contraction there in activity. The services side, non-manufacturing, was better, but 1 month we wouldn't read too much into, but if we start to see over November, December, these real-time indicators pointing to a slightly weaker economic backdrop, then that does have ramifications for the Chinese economy and their policy response.
Yeah, now looking at the UK market as a whole, I mean, October is traditionally not a great month. It's been the worst month since June. November, by contrast, is one of the best months traditionally. What are you expecting to see next month broadly?
Well, being an optimist, we always look for this, Santa rally into the year end. You're right that the last couple of months of the year typically have been, some of the better performers over the course of a calendar year. Yeah, we'd like to anticipate a bit of stability into the year end. It's going to depend, though, on lots of factors, both monetary factors. We've got central bank decisions coming up this week, but also geopolitical. What is happening in the Middle East. The market, at least over the last 24 hours, seems more sanguine that we're not going to see a spillover from Israel and Gaza into the wider Middle East. But who knows how that situation might change day to day. So we'd hope for stability. We'd hope for a bit of window dressing of portfolios into the year end, which typically provides a bit of a tailwind for equity markets. But too early to call it with any confidence.
Yeah, reasonable comment. Guy, good to see you as ever this morning. Thank you for joining me.
Thank you.
Some other business news stories for you now. And Vodafone has agreed to sell its Spanish arm to London-listed Zegona Communications for €5 billion. The operation, which is the third largest player in Spain's mobile market after Telefonica and Orange, was put up for sale earlier this year as Vodafone seeks to reduce its debts and focus on markets where it has a stronger position. Well, Zegona, which is led by the former Virgin Media executives Eamon O'Hare and Robert Samuelson, was founded in 2015 with the aim of investing in European telecoms companies and improving their performance. It will be funding the acquisition through a mixture of debt and new shares. Well, shares of Vodafone were up by 1% earlier this morning, but I think they're currently a bit drifty right now. World's biggest brewer, AB InBev, admitted last night to a 14% drop in US sales during the 3 months to the end of September. Well, the drop-off followed a consumer boycott of the company's flagship US brand Bud Light after it launched a marketing partnership with a transgender influencer. AB InBev, whose other brands include Stella Artois, Beck's and Bass Ale, reported total sales for the quarter of $15.57 billion. That was up 5% on the same 3 months last year. The trading platform and spread betting company IG Group is to make 1 in 10 of its employees redundant, representing around 250 jobs in total. IG said the measure was part of a move to simplify and streamline the business, better performing it for further growth. Well, separately, the wealth management specialist Brooks Macdonald has announced plans to cut around 55 jobs as part of an organisational shake-up aimed at saving it £4 million a year. Well, shop price inflation has eased for the 5th month in a row to its lowest level since August 2022. The British Retail Consortium says overall prices rose by 5.2% in October compared with last year. That's down from 6.2% in September. Food inflation was also down at 8.8% this month, compared with 9.9% in September. That's the 6th consecutive fall and the lowest since July 2022. Well, joining me now is Helen Dickinson, Director General of the British Retail Consortium. Helen, good to see you this morning. The thing that really stands out here is food price inflation. Can we definitively say that we're past the worst here?
I think we can say that we're past the worst. I think we are certainly expecting this downward trend to continue, but expectations should probably be managed that we're not going to hit the heady heights of below 2% anytime soon. So there is still some quite challenging conditions in the background that are going to keep putting pressures on inflation. But overall, this is great news for consumers. As you said in the opening, it's the 5th consecutive month of the fall, and that shift on food, which is such a staple, obviously for everybody, is a big piece of that good news and will be very welcome to households up and down the country.
And obviously lower food price inflation potentially means more discretionary spending available. So there's a boost potentially for non-food sales here down the line.
There is. Obviously, from a consumer point of view, people's disposable incomes are still under a lot of pressure, particularly in the lower end of the market. So we are leading into the most critical time of year certainly for retail businesses. And our expectations are that people will continue to be searching out, good value, and retailers will need to be on their toes and keep that investment up in ensuring that that value and that they're not passing on any more price increases than they need to their customers.
Now, in the statement, you mentioned that there were falls in baby and children's clothing in particular. But what are the categories where inflation remains at elevated levels?
I think probably particularly in some parts of food, particularly for imported areas, bread, cereals, because of the weaker pound, and there's still some trade frictions globally. Sugar, there are high global sugar prices. We've got this ongoing volatility in the Middle East and the real horrific scenes that we're seeing that is impacting on oil prices and transport costs. So it's certain food categories that are that much higher, and in electricals and health and beauty are probably, at the higher end in non-food. But overall, the headline is that this is good news, while it's not as low as everybody would like to see. And certainly from a government point of view, what we need to ensure is that they're not doing anything that puts further upward pressure on prices, because that would be bad for consumers in the lead up to Christmas. And business rates is our old favourite on that one. So we're trying to ensure that there's a freeze on rates next April.
Is that something that you'd be relatively optimistic about seeing in the autumn statement?
Never be relatively optimistic is what I'd say, Ian, because we've got to keep raising the need to ensure that it does happen. I have my fingers very firmly crossed. I know that every retail business that has been talking to government has been raising exactly the same point, and I'm sure that the Treasury will be working through, and we hope that they will take that inflationary trajectory that we're putting out today into account, because we don't want to see that downward trend jeopardised in any way.
Helen, just one final thought on the shop price inflation figures you've reported today. Would you hope that would be enough to make the Monetary Policy Committee sit on its hands this Thursday and not raise interest rates again?
I am no expert on the intricacies of the debates that are happening in the MPC, but I'm sort of hopeful that there are enough signs in the economy, both in terms of sort of economic activity, in terms of consumer sentiment being pretty low at the moment, that they certainly wouldn't do anything that will put at risk the sort of economic outlook. So I'm hopeful that we will see a hold on the current interest rate level rather than any more increases, because there's certainly still the impact of the increases that have been put through in past months still feeding through into consumers' pockets. So we've got to wait for that to take effect before putting interest rates up any further.
OK, Helen, got to leave it there. Appreciate you joining me today. Thank you.
Thank you.
Now, the number of companies declared insolvent in England and Wales during the third quarter has fallen slightly from the 14-year high recorded in the previous 3 months. It remains close, however, to the level seen after the 2008 financial crisis. The Insolvencies Service says that there were 6,208 registered company insolvencies during the 3 months to the end of September. That was some 10% higher than the same period a year ago. And the government has U-turned on plans to close railway station ticket offices across England. It comes after the watchdogs Transport Focus and London Travel Watch said they would oppose every single planned closure based on issues including the impact on accessibility. Now, Ultimate Products, which owns leading homeware brands including Saltra and Beldray, has reported record annual sales and profits in the face of soaring inflation and a housing slowdown. Well, the company said that total sales in the year to the end of July came in at £166.3 million. That was up 8% on the previous 12 months. Pre-tax profits for the year hit £16 million. That was up 4% on the previous 12 months. Well, joining me now is Andrew Gossage. He's the Managing Director. Joins me now live from the company's headquarters in Oldham in Greater Manchester. Andrew, welcome to you. You've sought to keep prices low. Is this sales uplift largely due to volume rather than price?
A volume and mix, yeah. I mean, we as a business, we want to be, beautiful products for every home. So we want to be within everyone's price point. So we've worked really hard to keep pricing as flat as possible. Also, not acknowledging that things like food prices, like we've seen with the last article, have gone up over the last couple of years. Not a great time to increase non-food prices. So we've worked really hard to keep our prices as low as we can possibly make them.
I mean, store sales were actually lower. It looks as if you're becoming increasingly an online business.
Yeah, well, online, we're starting from a lower base. But we have a good mix between our online channel, our discount channel, and our supermarket retailers. Those three channels now are broadly equal. which is something we've done a lot to achieve over the last few years. If you go back only 5 years, the majority of our revenue was from discounters. Even supermarkets were quite small at that point. Now those three channels are broadly equal.
Now, sales at Beldray and Russell Hobbs, of course, which you licensed, were down 12% and 18% respectively. What happened there?
As a Beldray, we did have some reduction in space on floor care with two of our larger retailers. Russell Hobbs, what we've seen over the last sort of 12 months or so, which is why we're really pleased with this performance, is we have seen sort of excess inventories in the retail channels. And obviously that's a challenge for us. We've seen that with Russell Hobbs. We've seen that with Beldray. Salter performed exceptionally well, but that was really helped by the performance via the online channel, plus also the performance of products like the air fryers and things which had an energy saving theme.
Now, you recently opened a new showroom in Paris. What is it about the French market that you particularly like?
Well, we see Paris as a European hub. It's a really easy destination to get to from all over Europe. The showroom itself is only sort of a 15-minute taxi from Charles de Gaulle. So we do very much see it as a European hub. France has a lot of attractions. I mean, the most obvious one is it's close, so it will be a more straightforward territory to serve from our UK base than say some of the rest of the world territories that we have in the past sold to.
Now, each year you look to introduce around 600 new products, which is I find absolutely astonishing. Which are the ones that have surprised you this year in terms of how well they've done?
Well, it's actually down from 1,000, so but you're right, 600 products is an enormous amount of product, and it is that innovation and newness that represents a USP for the business. It also allows us to reset pricing and margin, and over the medium to long term manage our gross margins in that way by always offering something new to the retailer and the consumer. I think at the moment anything which enables the consumer to save money, and I've mentioned air fryers, but it might be things as I suppose as relatively unexciting as heated airers, for example, slow cookers. These are things which are performing very well at the moment.
Nothing unexciting about that, Andrew. What about cost inflation? Where are you seeing that going right now?
Well, we're after a fairly extended period of sort of big input pressures. You remember 21, 22, the shipping crisis, increased freight, factory gate inflation was quite high because of excess demand out there. We've seen that kind of abate to a large extent. Factory gate prices are pretty stable. Exports from China are relatively quiet. Domestic demand is relatively quiet as well. Freight has crashed from a high of $18,000 to sort of just over $1,000 at the moment. So at the moment, it's fine. Obviously, that pendulum can swing very easily going forward. It's one of our, I suppose, key capabilities is managing those input costs.
All right, Andrew, got to leave it there. Busy day for your results day. We do appreciate you spending the time to chat. Thank you.
Lovely, thank you.
Now, materials like steel, glass, cement and copper are partially manufactured at temperatures hotter than a volcano. Well, doing that involves so-called refractory materials and equipment which can withstand extreme temperatures. Well, the world's biggest supplier of these is the FTSE 250 company RHI Magnesita, which today said it expects underlying earnings this year to be at least €380 million, up from the previous forecast of €360 million. Well, joining me now is Stefan Borgas. He's Chief Executive of RHI Magnesita. Stefan, welcome to you. Good to see you. You've obviously benefited from recent acquisitions, but you're also seeing strong demand, particularly from the cement and lime sectors.
Hi, Ian. Thanks for having us on the program. Actually, the demand situation all around the world, cement, lime, steel, copper, glass, is really terrible. It's the lowest demand since 15 years. We were able to upgrade our guidance because of all the great work that all of our people have done in the plants on the operational level. So it's on the cost side that we're making this progress, but not on the demand side at all, actually.
Well, that's really quite disappointing, given that you are a good barometer for global manufacturing. I mean, where are things weakest? I mean, it looks like steel is seeing sagging demand.
Yeah, the underlying root cause is a global weakness in the construction industry, pretty much all around the world except India. And in addition to this, weakness also in the automotive and transportation industries. And that compounded together leads to this really global, pretty dismal demand for those materials for the time being.
Give us some optimism, Stefan.
Well, after every downturn comes an upturn. So we have to, I think, calmly work ourselves through this period of time. Our capacity utilization is around 70%. This is low, but it's not a disaster, so we don't need to make any structural adjustments. We work very well together with our suppliers and our customers on stabilizing the global supply chains. This is also going well. The entire chain is getting ready for some demand increases. I think if we look to India, to the Middle East, to Southeast Asia, we have some good pockets of demand increase. So a little bit of patience, and then sometimes during the course of next year, latest the year after, things will recover.
And on the another positive one would hope for is lower material costs. Are you seeing declines in raw material prices to a meaningful level?
Yeah, raw material prices are at a very much of a low level. And I think the other area that this time now allows us to concentrate on is to really focus our view on getting CO2 emissions out of the entire chain. We have reduced about 1 million tons of CO2 emissions. That's about 20% of our total emissions since 2018. But now comes the time where we can accelerate this. Technologies are getting ready. We can test them because we have a little bit more room in our plants, in our customers' plants. And I think that's really good news for the climate for the years to come.
Yes, when we last spoke, we were talking about elevated energy prices, and you mentioned in particular that over time you would hope to switch to renewables, and in particular green hydrogen. What progress are you making on that in particular?
Of course, on green hydrogen, we are very much dependent on the infrastructure of the countries in which we operate all around the world to really make a step change. What we have done and still are doing at the moment is we're testing all of our plants on how they would perform under hydrogen operation. And we're making very good progress with this. The area where we've really made the biggest step forward on the CO2 side is to reuse a lot of the waste of our customers and process it back into our products. And this way, of course, for every ton of recycled material, we can save 2 tons of CO2.
That's very interesting. Which are the materials that are most commonly recyclable?
Well, actually, the refractories that we put into the furnaces of our customers are used up during the utilization, during our customers' operations by about 2/3, and the rest then is thrown away. We can use everything, eventually 100% of these wastes, and then we can replace roughly 30% of all of the raw materials produced today from mines with raw materials coming from waste. This is where we can get to, and there's not a 15-year technology development necessary. We can do it.
OK, Stefan, we have to leave it there. Do appreciate you joining me today. It's nice to catch up with you again, sir. Thank you.
Thanks, Ian. See you next time.
Well, that's it from me for the time being. I'll be back with the afternoon edition of Business Live at 4:30 this afternoon. Hope very much to see you then. Thank you for joining me this morning. Cheerio.